Welcome back. Today, we're diving into the top 5 index funds for 2024. Whether you're a seasoned investor or just starting, these funds offer a great way to diversify and maximize returns. Index funds might sound boring, but they're the unsung heroes of investing. They track market indexes like the S&P 500, meaning you invest in hundreds of companies with one purchase. This diversification mitigates risk and tends to have lower fees than actively managed funds. Ready to build a solid portfolio for 2024? Stick around as we break down the top 5 index funds you need to know about. Before we jump into the top 5, let's understand what index funds are and why they matter. An index fund is a basket of stocks or bonds designed to track a specific market index. Think of it as a pre-built portfolio you can buy with a single investment. Why choose an index fund over picking individual stocks? Diversification. By investing in an index fund that tracks the S&P 500, you're spreading your investment across 500 large US companies. Imagine buying all those stocks individually. Logistical nightmare and expensive. With an index fund, you get instant diversification with a low-cost investment. Another advantage is lower expense ratios compared to actively managed funds. Actively managed funds have higher fees because you're paying for stock picking. Studies show it's tough to consistently beat the market long-term. Most actively managed funds don't outperform their benchmark indexes after fees. Index funds are passively managed, keeping fees low and allowing more of your money to grow. This is crucial for younger investors starting out. Even small fee differences can compound over decades, significantly impacting returns. Index funds are also more tax efficient due to less frequent trading. Fewer taxable events mean you keep more of your gains. Investing in index funds is simple and effective for long-term wealth growth. They're diversified, low-cost, tax-efficient, and take the guesswork out of investing. Next, we'll dive into the first index fund on our list, so stick around. Let's kick things off with a legend. The Vanguard 500 Index Fund, ticker symbol VFINX. This fund has been around since 1976 and tracks the S&P 500 index. By investing in VFINX, you're buying a piece of 500 large US companies like Apple, Microsoft, and Amazon. This broad market exposure makes VFINX a core holding for many investors. VFINX has an incredibly low expense ratio of just 0.04%. You're paying only 4 cents for every $100 invested. Over time, these small fee differences can add up, leaving more money in your pocket. Vanguard is known for its investor-friendly approach and low costs. Vanguard is owned by its fund shareholders, allowing it to keep fees low. VFINX is a mutual fund priced once per day at the end of the trading day. If you prefer an ETF version, check out VOO, which trades throughout the day. Both funds have the same holdings and similar expense ratios. The choice often comes down to personal preference and trading style. The Vanguard 500 Index Fund is a fantastic choice for all investors. It's simple, low cost, and effective for gaining US market exposure. Invest in VFINX to potentially grow your wealth long-term. Next, let's explore another game-changing index fund. Let's talk about a game changer, the Fidelity Zero Large Cap Index Fund, FNLX. Zero fees. Yes, it's true. Fidelity launched Zero funds with a 0% expense ratio. FNLX tracks the Fidelity US Large Cap Index, similar to the S&P 500, but includes more companies. Fidelity makes money through securities lending and cash management, not direct fees. FNLX provides a zero-cost way to invest in the US large cap market. It's an attractive option for long-term investors wanting to minimize fees. Note: you'll still be responsible for any trading commissions from your brokerage. Many online brokerages offer commission-free trading for ETFs and some mutual funds. FNLX is a no-frills, low-cost way to invest in the US stock market. It's a testament to the competitive index fund industry, a huge win for investors looking to keep more of their money. Next, let's look at another low-cost index fund option. Next up, the Schwab S&P 500 Index Fund, ticker symbol SWPX. This fund tracks the S&P 500 index, giving you exposure to 500 large US companies. SWPPX has an incredibly low expense ratio of just 0.02%. You're paying only 2 cents for every $100 invested. This makes SWPPX one of the cheapest S&P 500 index funds available. SWPPX is also known for its tax efficiency due to less frequent trading. Fewer taxable events can lead to greater after-tax returns. Schwab is a reputable brokerage known for its low-cost investing movement. SWPPX is a mutual fund priced once per day. For an ETF version, check out IVV. Both have the same holdings and low expense ratios. The Schwab S&P 500 Index Fund is an excellent low-cost, tax-efficient option. Next, let's explore a popular ETF option. Let's talk about a popular ETF, the iShares Core S&P 500 ETF IV. IV tracks the S&P 500 index, giving you broad U.S. large-cap market exposure. IVV stands out for its low cost and high liquidity. With an expense ratio of just 0.03%, IVV is one of the cheapest S&P 500 ETFs. EVDV is highly liquid, making it easy to buy and sell shares throughout the day. This high liquidity is due to its massive asset size and popularity. IV is offered by iShares, a subsidiary of BlackRock, a leading asset manager. iShares offers a wide selection of ETFs for diversified portfolios. IV trades like a stock, providing more control over trades. ETFs are generally more tax-efficient than mutual funds. The iShares Core S&P 500 ETF is a low-cost, highly liquid, tax-efficient option. Next, let's discuss a pioneer in the ETF space. Last but not least, the SPDR S&P 500 ETF Trust SPY. SPY was the first US-listed ETF, launched in 1993. It tracks the S&P 500 index, offering broad US large-cap market exposure. SPY is known for its unparalleled liquidity and long track record. With billions in daily trading volume, SPY is one of the most traded securities. This liquidity is crucial for large institutional investors. SPY's long track record provides confidence in various market conditions. SPY's expense ratio is 0.09%, slightly higher than some peers. However, its liquidity and track record make it compelling. SPY is a highly liquid, time-tested way to gain U.S. market exposure. It's a popular choice for both individual and institutional investors. Next, let's wrap up with some final thoughts. Thanks for watching. If you found this video helpful, hit the like button and subscribe for more investing tips. Let us know in the comments which index fund you're most excited about for 2024. Happy investing! Remember, investing is a long game. Start early and stay consistent. These index funds are excellent for starting or adding to your portfolio. Always do your research and consider your investment goals and risk tolerance before making any decisions.